Hey, good evening, everyone. Thanks a lot for joining us in what we know it's going to be a very, very special panel, right? We here at XP are very happy to be hosting this International Week. We think the timing couldn't be better. We're coming to a crossroads in the global macroeconomic developments. You know, there are lots of things to be discussed. And we are very, very fortunate to have two of the best global experts that help us navigate such interesting times in the Chinese sense of the world, right? So I'd like to welcome Andrew Slimmon from Morgan Stanley and John Boselli from Wellington. We're going to start with, a brief introduction by each of the panelists. They're going to speak for about 10 to 15 minutes to basically let us know how they see the global situation, investment philosophy, portfolio construction, how to deal with a situation that to a certain extent is unprecedented in our careers, of massive demand shock, massive supply shocks, all over the place, right? Inflation up, inflation down, United States growing 6, Europe growing 5, all of those things that are happening that are very unusual in our careers. So they are going to let us know how they are dealing with that, how they structurally construct portfolios, and how they deal with all what's going on at the global level. Yeah, why don't we start with Andrew? Andrew, thanks a lot for joining us.
Great, thank you for having me on. And thanks for everyone for listening in. And Morgan Stanley Investment Management, we're delighted with the partnership with XP on this global BDR fund. So we look forward to rolling it out. Look, I've been, as pertains to your initial comments, I've been in this business for 33 years, and there's really only one consistency to this business over time, and in my mind, that's the conflict between human emotions and the equity markets, and that's what my specialty is, equity markets. And by that I mean that as humans, we frame our views about the future based on what's happened in the past, especially recently in the past. Stock prices don't care about what's happened in the past; it cares about what will happen in the future. And oftentimes, stocks offer the best opportunities when they've already gone through that tough recent past, and it's because of that consistent conflict that there are patterns to investing that occur over and over and over. It's just very hard for investors to see that because it's overlaid with that emotion. And I think last year, what happened last year and what's happened this year is exactly picture perfect for that. But by that I mean that if you had studied previous pandemics, and we know the markets are still in the midst of pandemic, but had a very tough go, particularly the first part of last year. And yet, if you had studied previous pandemics, is not the first pandemic and how it affected the equity markets. We had the Asian flu, Hong Kong flu, Spanish flu. There's a very consistent pattern to that, which is the markets tend to drop more quickly than normally in a recessionary economic situation, and they recover much more quickly. That's what happened previously, and yet, because of that recency bias, if you look back to March, April, May, a tremendous amount of money was liquidated out of equities at very low levels. And so again, what we saw this quick recovery based on vaccines and government's response to this pandemic. And so I think that's how that's really what we try to capture in our funds. We run core funds because I know that from time to time there will be situations where people will oversold the market or overbuy the market. They will favor growth or value. They'll favor US or Europe or Japan or Asia or other parts of the world. And can we take advantage of that consistent behavior? And as it pertains to portfolio construction, what I see going on right now is that we're seeing yet again, a consistent pattern as we saw last year with the recovery in the market. What we're seeing is a very consistent pattern, which is in recessionary situations like we saw last year, investors sell cyclical stocks, the stocks that they're worried are going to go to zero, materials, financials, industrials, all around the world. And that's what happened last year. That's what happened in 2008. That's what happened in 2000. That's what happened in 1990. But coming out of recessions, those stocks always do the best because they get too oversold and then they reprice back to, they're not going bankrupt. And what's interesting this go around is if you wind the clock back to 2009, what you saw is that the banks did very well coming out of the pandemic. The cyclical stocks did very well. Well, this time they didn't bottom and start to outperform at the bottom of the market March of last year. They only started to outperform when it was clear that there were vaccinations on the horizon. So when Pfizer, Moderna's news came out, that's when cyclical stocks around the world started to outperform growth stocks. So there's been a lag in their recovery, and we think it has more legs, at least to get back to where they normally trade. So I think cyclical stocks will continue to lead. Now, that's just getting back to normalized valuation. The however is that there has been a significant change in central bank policy from where we've been since 2010. Namely, if you look back and you analyze markets, value stocks, cyclical stocks have done better from really 1980 to 2007 than growth stocks. But then from 2010 until this pandemic, growth stocks did better than value stocks. And so what's the difference between those two periods? It really has all to do with central bank policy. After the great financial crisis in 2008, which was very much caused by central bank policy that let bubbles, housing market, become too bubblicious, central bank policy was very quick to change and taper and adjust policy sooner, tighten, and it didn't allow economic growth to really recover the way it had in the past. Janet Yellen, even a former Fed chair, who's now Secretary of Treasury here in the United States, has said we were too quick to change policy. The result is that we had subpar growth around the world for better part of a decade. And that is an environment where cyclical stocks don't work and growth stocks do work. So we think we're in an environment where that is adjusting. And we think that central bank policy is going to sit on their hands and let the economies run hotter than they have in the past. And that does mean, to your original question, some inflation out there. And so we think the positioning in an equity portfolio should be more into value stocks. Again, I'm not a value manager. I'm just trying to take advantage of what the market is offering. And we think that there's a good run left in value stocks. Now that has implications for the dollar, and then I'll turn it back to you, dollar and positioning around the world. Number one is in a central bank where probably the United States is the most accommodative, it's quite likely that the dollar will depreciate. And if you look at the period from February of 2002 to July of 2014, the dollar depreciated against the rest of the world by about 30%. And the S&P did not do as well as the rest of the world, particularly the emerging markets. But from 2014 until the pandemic, the dollar rallied. And in that period, the S&P was the best performing market index in the world, or of the large versus emerging markets or MSCI world. And so really the dollar is going to determine what's going on. And we believe that in this environment of a more accommodative Fed, which could lead to some inflation, we think we'll see the dollar depreciate, and that will probably be better for rest of world outside the United States than in the United States. So S&P quite likely could lag other parts of the world. The other thing to consider is that the Europe and Japan are more global and more cyclical in nature. And in a faster growing global economic environment, it's quite likely that those markets would also outperform a more growthier S&P 500. So again, we're core, we're agnostic. That's how we see our positioning. The last thing that I would say is I'm a believer in buying markets and I'm a believer in buying stocks. But what I'm not a believer in is buying hundreds and hundreds of stocks. So we try to limit in our fund to 20 to 30 stocks, because I'm not looking for positions I think can go up 20, 30%. We're really looking for stocks that we think can move much more substantial, and then they make a difference to the returns. And we still think there's a lot of runway left in these cyclical stocks, particularly in financials and energy stocks. So with that, I'll turn it back to you.
Thanks a lot, Andrew. John, thank you very much for being with us. It's your turn.
Sure. Thanks, Arthur. So I'll go through my investment philosophy and process quickly, and then our macroeconomic outlook. So our investment philosophy, it's very simple. We believe companies that compound value at a high rate of return and that grow above market averages and that distribute cash flow back to shareholders while trading at a discount to the market, those types of characteristics in stocks tend to lead to outperformance over time. We're very much bottom-up stock pickers. We don't do much macro top-down allocation, and it's really one stock at a time. In terms of process, I'm very much a process-driven portfolio manager. I'm an engineer by training, and believe the key to generating consistent outperformance is avoiding expensive, lower quality, slower growing companies from our universe. And so as part of our initial part of our process, what we do is for every company in our universe, we forecast a revenue growth rate for 5 years into the future and a free cash flow margin for those businesses. And we do this by talking to Wellington. We have 60 global industry analysts around the world with about 700 investors throughout the world. And we meet with companies daily. And based on our investment experience, we forecast the growth, the revenue growth, the margins, capital intensity, and free cash flow of all these businesses. And then we have conversations with these management teams about capital allocation and returning capital to shareholders or M&A. And then finally, we have a process of avoiding companies with negative revisions. And the reason we do that is 60% of the time, companies with those negative revisions on a forward-looking basis, they tend to underperform the market pretty consistently. So again, our process forecasts the growth, quality, valuation, and capital return factors over the next several years to understand the direction and relative change across companies in our universe. And most of our research time is identifying those business models that can sustain high organic revenue growth and quality, but operating in sectors that have positive fundamentals. Our portfolio tends to have about 60 companies, and every position in our portfolio is actively weighted between 100 and 150 basis points versus the index weights. On an industry basis, we do avoid companies that have deteriorating fundamentals, and conversely, we only are investing in companies with improving fundamentals. So we do make fairly large sector bets. And this fundamentals we measure in terms of either better pricing, improving margins, or lower capital intensity, anything that will drive the returns on capital employed or the free cash flow margins higher. At the stock level, we really are focusing on those companies that are gaining market share across the industry or sector in which they're competing, and that to be driving operating efficiencies and greater shareholder value creation over time. We interview every management team in the portfolio, in most of them in the universe. And we'll ask the same 20 questions every time we meet them. And those questions are focused on strategy, culture, incentive compensation, cash flow generation, and now more importantly, ESG risks and opportunities. In terms of portfolio construction, once we have the industry and stock level analysis complete, we then rank all the securities in our universe by their level of attractiveness and total return potential. And the stocks with the highest combination of quality growth, valuation, and capital returns plus revisions are included in the portfolio, and we weight those positions between 100 and 150 basis points, which typically results in about a 60 stock portfolio. Now, our outlook is really based on three things. One is the vaccine rollout globally. Second is economic confidence, and third is stimulus. And we think those three lead to a combination of higher growth and higher inflation. And so by next month, we expect about 1.2 billion people globally to have the vaccine. And we think that goes to about 5 billion in early 2022, which is the bulk of the population around the world. The COVID policy response has led to one of the larger economic bounces on record. We expect in the second half of 2021, many of the Western countries to have about a 15% GDP growth on an annualized basis, which is one of the fastest in 40 years. You're seeing ISM at a cyclical high, a lot of job creation, a lot of consumer confidence, and that's leading to higher than anticipated earnings growth. Along with that growth, we're seeing a lot more inflation in the system. Our forecast is for inflation to be above 3% towards the end of 2021 and early 2022. And that's versus a 10-year average of 1.4%. And that's a very significant difference going forward. This is being driven by China's, which had a fairly persistent deflationary supply chain force. That's easing now. The RMB is strengthening versus the dollar, and there's much less inventory in the system. And the pricing power, which has been missing for a long time, is returning. Also, the US monetary and fiscal response with the Fed's focus on outcomes instead of forecasting, that will also create inflation risks. And we think the US demographic shifting to more millennial spending versus the baby boomer savings, that will be a higher spending impulse and less deflation going forward. So we do expect the Fed to taper in the fourth quarter of this year and rate hikes in 2022, almost 150 basis points from the low. And that will lead to a steepening yield curve as a 10-year bond yield approaches 3%. And so how that's positioned us on a sector basis is we're more overweight technology, the cyclical technology sectors. So this would be semiconductors and some of the enterprise software businesses. We're also very overweight financials. That's our largest overweight in the portfolios. And we're also overweight industrials. So we're leaning towards a more cyclically positioned portfolio. And we're underweight consumer staples, utility stocks, healthcare stocks on a relative basis. Geographically, we're overweight North America. And this just the amount of stimulus in the system and the dominant positions of some of the technology businesses in North America. We're also overweight China, less so today than we were 3 to 6 months ago, but they've been able to contain that virus. You're seeing accelerating growth in the first half of the year, and services are driving a lot of that improvement. Once per capita GDP reached $10,000 in China, a lot of the consumer discretionary businesses in China are seeing accelerating fundamentals, and we're overweight some of those businesses. We also are overweight Europe. A lot of the fiscal packages have improved the supply-demand relationship. We're expecting 5% GDP growth in 2021 and 2022 in Europe, which is very high on a relative basis over the last 10 years. And we do think some of that inflation pressure in the US, you'll see that at the back end of the yield curve, which is the first time you'll see that in a decade. We're underweight Japan and emerging markets. We think Japan has fewer measures in their toolkit. Rates are already negative, and they've been negative for some time. Debt levels are very high, and the aging society and shrinking population does affect nominal GDP growth in Japan. So we've been underweight Japan for some time, and we remain so today. Emerging markets outside of China, we are also underweight. A lot of political instability, fairly high debt burdens, and that's put a lot of pressure on GDP growth. So that's the positioning and the philosophy and process with our economic outlook, Arthur. So I'll send it back to you.
Well, thanks a lot, John. Well, let me ask a question to both of you. Both of you mentioned, an economy that is running hot, right? And if I take Andrew's point, which is, adaptive expectations, or the market always fighting the last battle, right? Or battles from the last war, we're not used for a much higher cost of capital, right? I mean, we spent since 2008 in an environment where people got used to very low real interest rates, close to zero, negative in some places, right? What if that changes? I understand that, cash flows are accelerating, right? So the question is, what in your opinion, both of you guys dominate? Is the increase in cash flow or the increase in the discount rate? I mean, do we panic at some point if the 10-year gets at 3 or something like that? Well, I'd like to start with John this time.
Oh, start with John. Okay. So yeah, it's interesting. The higher discount rates obviously affect higher multiple stocks more. And it has to do with the duration of that cash flow. And to the extent the cash flows are further pushed out, that has a more dramatic effect on the value of a business. It's just the way the division works. We in our portfolios, once a stock hits 30 to 33 times enterprise value to forward free cash flow, once a stock hits that sort of multiple, we tend to sell the position entirely. And that's based on a backtest analysis, which proves that the majority of companies that trade above 33 times EV to free cash flow, regardless of the growth rate, those businesses underperform markets over long periods of time. So we control the interest rate risk by owning companies that have a market multiple or less on a valuation basis. The second thing that we do is we avoid companies that have significant cost of goods sold, in which the gross margin is materially affected by rising inflation. And so a lot of those businesses with modest gross margins that are more cyclical in nature, that are impacted by cost of goods sold, we tend to avoid those businesses. The average company globally has about a 10% free cash flow margin and a 10% return on capital employed. The average company in our portfolio has about a 22 to 23% free cash flow margin and return on capital employed. Their cost of goods sold is relatively modest, and they generate high gross margins. So we look at the rising interest rates and being overweight financials and some of the cyclical sectors, but really focusing on those companies that generate a lot of cash flow and avoiding the very expensive stocks in the universe.
Andrew?
Yeah, so look, I think I agree with John, which is cost of capital going up, which has not been the case in the last decade, means that different types of stocks are going to work. And I think that is, for all the reasons I said, which is kind of the recency bias, that's not what's worked the last decade, and that's not how investors are positioned. Maybe John is, maybe I am, but that's not the way investors are positioned. They are overweight in what has worked the last decade, and that is in stocks that benefit from this low rate environment. I'll give you a great example of that. If you look at the percentage of earnings just of the, say, the S&P 500 that comes from the financials, and you compare that to the weighting of financials, their earnings drive so much more of the S&P than their market cap, which means that they are carrying a lot for their market capitalization. That means investors aren't appreciating how much in earnings they're driving the S&P. And all that says is investors are not positioned appropriately for this rising cost of capital situation that I believe that we are in. And I believe it because I'm listening particularly to Jerome Powell, who keeps saying inflation is not important. It's the unemployment rate. We have to have more people participating. When you have a decade of subpar economic growth, it creates tremendous income inequality. And that's what's happened. The gap between the wealthy and the middle class has gotten very wide, particularly here in the States. And the result is you have a shift in politics. So the bring down the unemployment, improving the participation rate is more important than the inflation for the Fed. That's what they're saying to us. I believe that. And in that situation, you're going to see cost of capital go up. You're going to see some more inflationary pressures. I completely agree with what John said, a very important point, which is you want to make sure and focus on companies where their costs are not as impacted by rising inflationary pressures, namely commodities. And you probably saw today, there was 2 consumer staples companies that said their costs are rising, that's going to squeeze their margins. So in that environment, it does require some analysis of truly what the cost inputs are. But I believe that that this is what is causing a more cyclical bias, which, by the way, we've gone through periods that equities have done well in that environment. It's just different types of stocks.
If we talk about disruption, right, which was the previous theme, right? The previous theme was everything was going to be disrupted, right? I mean, and that's kind of what created this massive disparity between value and growth, right? Amazon was going to eat the world, right? I mean, how do you guys think about that? How do you guys think about disruption in the context that, you know, some of the cyclical stocks were the ones that are at least were pinned down as being disrupted, right? Auto companies and things like that. How do you combine those two factors? I'll start with Andrew.
Yeah, so look, we're doing a great call today. It's disruptive. So it's disruptive technologies that has created this opportunity. I find I'm incredibly more efficient because of the technological improvements. But there's 2 inputs to stocks. There's the fundamental, what's going on fundamentally, and it's the price with which you're willing to pay. And I believe that those stocks, many of these stocks got very expensive last year. And in a rising interest rate environment where more companies that will participate that don't necessarily in disruption, I think you're seeing it already. You're seeing multiples come back to levels that are more sustainable. John talked about not paying a certain price for certain stocks. I completely agree with that. And I think in this environment, that is even valuation overlay becomes even more important because interest rates rising becomes a competitive stock. So it requires, if there's the balance between what have great fundamentals, but what's the right stock price, I do believe in this environment, even being even more mindful to your valuations becomes important.
Mm-hmm.
Yeah, I would answer that. You know, we spend an extraordinary amount of time at the stock level, and so to find those companies that are benefiting in this sort of environment, just regardless of inflation and interest rates. So we just put that on the back burner for a moment. But you know, there are companies like Airbus and Safran, both French aerospace oriented businesses. Airbus taking market share from Boeing in the narrow body, and also on the wide body from some of the wide body manufacturers, the engine manufacturers and whatnot. But Airbus is a company that went through a period of 18 months in which the number of planes they sold and distributed were close to zero. You're going to see that acceleration. Air travel is coming back. Demand for efficient planes that are CO2 light, that are more environmentally safe. That's driving Airbus to take market share on the narrow body from 50% to 55 and even into the high 50s. So you've got an umbrella in which Airbus has a backlog of roughly 6 to 7 years in duration, and it could be longer. It's just that they don't book planes that far out. And then Safran is the CFM joint venture with GE Aerospace. And this company dominates on the jet engine side because their engines are just much more efficient than where the Pratt and Whitney's of the world or the Trent engines by Rolls-Royce. But identifying these companies and these businesses that are very well positioned to gain market share in the industry in which they compete, they're going to be able to keep that pricing leverage relative to the industry and for their clients, because they're offering a value to their clients. Another example would be Volvo, which is a fairly boring truck manufacturer in the Nordic region. They're the leader in EV trucks and the manufacture of these EV trucking businesses. And what's interesting is, instead of selling a combustion engine truck, selling an electric truck, the revenues associated with that truck are about 25% higher, because there's a service component to the EV trucks that you just didn't find in the combustible engines. So we think Volvo's growth rate over the last decade was maybe 3 to 5%, but we think over the next 5 to 10 years, Volvo's growth rate is going to be mid to high single digits, and that acceleration in growth is going to drive margins much higher. So, we do look top down, but that's about 2% of our process, 2 to 3% of our process. I wouldn't overestimate the interest rates impact in our portfolio, at least. We really are looking for those businesses that have some sort of competitive advantage that allows their business to accelerate with better margins, better cash generation, and capital allocation to build a portfolio.
One theme we've been discussing here at XP, which has been a fairly long trend, has been that profits have been growing faster than GDP, and there are a lot of structural reasons: globalization, automation, things like that, right? Do you guys at the micro level, because we're starting to see some wage inflation picking up, do you guys see it at the companies you invest? Should we worry that we get a margin squeeze, or a world where wages gain back a little bit of what they've lost since the 70s to profits, just because, we will end up with tight labor markets? Is that something that you guys see in the companies you talk to, or you worry about at the macro or micro level at all?
Oh, for
let's
sure.
Start with John.
Yeah, Andrew just spoke, talking about two consumer staples companies that were discussing cost pressures. And I think the combination of just-in-time inventory on a global basis and sort of precision, I call it precision manufacturing of only investing just enough to get by, that's led to shortages in many, many different product categories, especially semiconductors. And it really gets back to identifying companies that are in this position, the suppliers to those industries. I think is very important. We've been overweight semiconductors for about 18 months. We've reduced some of that overweight just based on valuation. But identifying these companies that benefit from these shortages is really critical to finding the winners, the stock winners over the next 3 to 5 years. Again, owning companies that have relatively low cost of goods sold, relatively low labor costs as a percentage of their total cost base, because I do think wage inflation, at least for the next 12 to 18 months, is going to be higher than anticipated. And so we tend to avoid those companies that we forecast to have falling gross margins over the next 12 to 18 months.
Andrew?
What I would add to that, which I think is fascinating, is we all know that things like lumber prices and commodity prices have gone up a lot. And really, when you think about it, it should be a surprise, right? you shut down economies. You can't just restart them. It's going to take time to replenish inventories. So I tend to agree with listening to the Fed, who's some of these inflationary pressures are transitory. And that's going to squeeze margins on a short-term basis in those commodities. The however is that if lumber prices come back down, well, that'll be good for the housing industry. But once you raise wages, can't cut them. You won't be cutting them in the near future. So wage inflation is going to last a lot longer than commodity inflation. So I think that that's an important nuance when you're thinking about companies to invest in. Are they heavily wage impacted? Can they pass on those costs to their ultimate buyer? And look, on the one hand, we have tremendous amount of excess savings, and that should allow people to be willing to pay higher costs. On the other hand, what we're seeing already is that consumers are spending the extra money, but they're already price sensitive and moving to the areas that have not seen the price increase. So in other words, housing prices have gone up a lot, and therefore the housing market is starting to slow, and you're starting to see a rotation into apparel because those prices haven't gone up a lot. So spending will continue, but it will continue in the areas that you haven't seen as much of the inflationary pressure.
There's another thing we've been discussing a lot, which is industry concentration, right? Now, people talk a lot about this, big tech oligopolies, but what you've seen usually across industries in the US is that you've seen industries that are being more and more concentrated, right? I mean, and there's a famous Goldman Sachs paper which they talked about the star economy, right? I mean, the fact that the leaders are much more productive and the second tier guys are not being able to catch up, right? So here are two questions for both of you guys. I mean, first of all, do you actually see that concentration, and do you see any regulatory risk in the US? And the second question is that what you see at the micro level, the leaders being much more productive and the second tier guys not being able to catch up? Let's start with Andrew this time.
Yeah, so look, yes, on the one hand, there is tremendous concentration risk. I think the top 5 stocks in the FANG stocks almost got to 30% of the S&P last summer. But those stocks really have not done particularly well. And that's, gives me tremendous comfort, because the last time they got to that level of concentration was in the year 2000. And we had a 38% decline, in the market, and the big boys really got hit hard. And it took a decade for many of those stocks to come back. I mean, I always like to tell people, Microsoft is a great company, but it took from 2000 to 2015. It took 15 years to get back to where it was in the year 2000. So again, it goes back to be careful what you pay for prices. Even good companies can take a long time. Now, the good news is we didn't have a bubble that burst. We've had an unwind in that concentration since last summer. The equal weighted markets have outperformed the cap weighted markets. And that means the really big guys have underperformed. And I think that's very good news, and it's very healthy for the market. As it pertains to regulatory risk, I think the biggest risk is actually tax risk, which is because those stocks have been such big winners over the last decade, that if there is tax changes, capital gains tax increases here in the States, those stocks will be the ones that will be sold first, because they've captured so much of the capital gains over the last decade. So I perceive that is more likely. I've heard about regulatory risk. It's been an overhang for a while, but I think it's much more likely that we'll see tax reasons why that could burden those stocks more than regulatory risk.
John,
Yeah.
I mean, and let me ask you, let me add one caveat to that, right? When we talk about the regulatory risk, right, the Europeans have been trying for a while, right, to regulate those great oligopolies in technology without any particularly big success, right? One train of thought is that, look, you try to regulate a business, you just raise the barriers to entry, and all of a sudden those incumbents are actually much more powerful than you wanted to begin with, right? How do you guys think about that?
Yeah, I mean, especially when you're offering that product for free, right? So,
True.
Google is when you put into a search engine, I want to buy running shoes, the results come out and they're free to the user. So it's very difficult to regulate those types of businesses. The governments will try to regulate that, and they'll be successful in some areas, but understanding the addressable market of these businesses, I think is as important as the regulatory environment. So, I was going to answer your question on the concentration in certain sectors, and my response to that is this has been going on for 100 years. In some sectors, there's the sectors concentrate. I mean, just look at Standard Oil back in the 30s and 40s. It was the dominant oil company. It was broken up, and that breakup created more economic value for the companies that eventually became from Standard Charter. And look at AT&T when it was broken up, and you've got the regional bells, and the regional bells created new technology, new services. So this concentration in sectors, I think it's been going on for years. I think what's more important personally is that the stock market is a weighing machine, right? And the stock market is weighing the anticipated growth of a business, the returns on capital employed, and the valuation. Those are the three big components that drive stock prices in our estimation. And so that's what we do in our process is we're trying to find those companies that have above average growth, above average quality, but the market, for whatever reason, is pricing it at a discount. And on top of that, the management teams are very efficient at allocating capital, whether it's back to shareholders through dividends and stock repurchase or M&A or the balance sheet. It's interesting, if you look at today, an industry that's kind of been left behind a little bit is some of the merchant acquiring businesses. So companies like Global Payments and Fleet Corp and FIS, these are businesses that assist the digitization of currency transaction away from cash into the digital realm. They were pretty good stocks in the mid 2015 to 2018. But the economics of the business have really just been healthy and remained in check, and those businesses have underperformed for some time. So I do think that the sector views are important, but I think it's much more important to look at the company level and to identify those businesses that are not being priced appropriately.
Both of you guys invest globally. Here's a question we get a lot, and that's a problem we have to deal with in our portfolios here at XP, right? I mean, when I started in this business 25 years ago, emerging markets was Latin America and Asia, and they were about the same size, right? And Brazil was the biggest weight, right? Now, I mean, we're nowhere to be seen, right? It's all about Asia. With good reason, they have, delivered into growth. But Asia has done more than that. It went from being a theme to actually creating global investable franchises, right? They're a pretty good business over there. But they come, especially some in China, some in Taiwan, they come with a certain level of risk, which is difficult to access, right? So how do you guys think about that? How do you guys think about investing in China, in geographies where, let's call it political risk is somewhat higher than we're used to?
Well, I'll give that a shot first. Yeah. Andrew talked earlier about the financial system. The banks have a higher percentage of earnings to market cap. And if you look at China on a global basis, their relative size to the overall global system, you know, the percentage of GDP they have on a global basis is in the mid to high teens, and their weights in the indexes are high single digits, and 10%. And we just think that's naturally going to rise over time. Listen, we have about 200 investors across Asia Pacific. What I find most interesting is the average Chinese business person is a capitalist. And you know, they're creating business models. They've been educated in the West. These are very smart individuals. You know, they've got an addressable market of 1.3, 1.4 trillion persons, and they can see the businesses in the Western hemisphere that have dominated and succeeded, and you know, finding the reasons why these companies have had such great success is being duplicated in China and some of the Southeast Asian countries. So we've been overweight China for about 18 months. That overweight is now at lower levels, probably one of the lower levels we've had in some time. But we do think there's quite a bit of growth in China. It's important to understand the regulatory environment, especially in China, because the government's control of businesses there is much greater than you'd find in Western markets. So that regulation in China is a big deal, and we spend a lot of time with that. But you know, there are great businesses, great addressable markets, great growth companies that are still being priced at levels that we think are too cheap on a global context.
Yeah, I mean, I would love to just pick up on that. When you think about and I agree with positioning in China. If you think about kind of the Communist Party, Chinese Communist Party, the social contract, right, is, you know, you forego political freedom for capitalistic success. And I think there comes times to time when they remind companies who's the boss. And I think that inevitably those come after periods of tremendous financial success of those companies. And when that occurs, inevitably the enthusiasm for those stocks is high. And when that period of clamp down ends, the enthusiasm for those stocks is low. And we are going through a process right now where the Chinese government is reminding investors and companies who the boss is. And that creates an opportunity to increase exposure in those stocks. I don't know when they will say, okay, fine, we're through this. But I know these stocks are down. Many of these big, very large internet stocks are down a lot. Alibaba, Tencent, so forth. And that creates an opportunity as long as you're not expecting that the coast is clear in a week. I don't know when it's clear. I just know these stocks are a heck of a lot cheaper than they were, and the enthusiasm for them is a lot less than it once was because of what the CCP has done. So I think that again, it goes back to that battle between recency bias. Oh, it's bad, we better get out. And well, stocks are now discounting a lot worse outcome, even though their growth rates remain very strong, obviously. And that creates a good opportunity looking forward in those stocks.
Andrew, you mentioned the social contract, and another interesting concept that we find different Asian place. But I mean, whenever we invest in Japan, we always have the idea that Japanese company, if you think about an American company, they say, look, I mean, the logic is very clear. You maximize shareholder value, maximize the value for society, you maximize employment all of a sudden. You talk to a Japanese company, they say, look, we have to maximize three things, right? We have to maximize value to shareholders, to the government, and to our employees, right? We're here with this three-pronged approach, right? And corporate governance reform in Japan has been talked about for a long time. And you can see there are assets that are under earning. Do you guys buy that story? if at all. That was the golden arrow from former Prime Minister Abe, right? I mean, which how do you guys see that?
Yeah, so we have no exposure to Japan in our global strategy. So I guess that
Enough
answers
said.
that question. The reason for that is I have heard the story of change in corporate governance for many, many years. And I have lived through companies that suffer exactly what you're listing, which is they could make changes that would unlock tremendous shareholder value. And for reasons that are not, stock price performance related, they're unwilling to do it. So I think this is if you think about Japan has underperformed the last year, 5 years, 10 years. I don't know, I don't know when it's going to turn. I'm not smart enough to figure it out. But what I know is that everyone that told me 3 years ago was about to turn anything wrong. We just, and we speak to companies, and we do a lot of what, and we have had these conversations, and it is clear to us, and there's some exceptions, but it's clear to us that there's less of a willingness. And I very much view, look, I have a limited amount of capital. I'm a believer in concentrated positions because I want to find stocks I have high conviction that I think we can double, triple our money in it. And I just don't want to commit capital in that part of in that country because I'm less convicted that the corporate governance is truly changed.
John?
I would answer it a little differently. There are pockets in Japan of truly great excellence, and a lot of the industrial automation companies, SMC or Hoya or these businesses that help manufacturers more efficiently produce goods and services and whatnot. So there are pockets of excellence in Japan, but I think that a country that has nominal GDP growth issues, it's very difficult for them to create businesses and industries that can take advantage of global trends. And it's typically these companies are growing at very low rates, whether it's financial companies, banks, retailers. A lot of these companies have a difficult time growing within their own markets, so it's hard for them to expand outside of the home markets themselves. There is one business, Recruit Holdings, which owns online placement services in the United States and in Western Europe. They were able to break out of Japan and identify a segment that they could dominate globally, and it's been a high growth, high quality business, and it's compounded value for some time. But a lot of what we find in Japan is mostly the very high industrial automation technology businesses that are cheap. We don't find that valuation support today, and so we're essentially on just one business in Japan.
Okay. So going back to the US and the theme of technology, which I think we need to explore a little bit more. I mean, there has been this idea that, look, I mean, there's a new way to create wealth, which is, the market now pays for intellectual capital and for data, right? Instead of physical assets, we're paying for ideas, right? These are the big trillion-dollar companies, right? Do you guys think that the competitive position of those companies is as undisplaceable, if there's a word, as the market thinks it is? Can we, displace Google? Can we displace Amazon? And should we value intellectual capital the same way the market has been valuing recently?
So, you really have to examine that, one technology at a time. And it's, Amazon, when you think about their competitive advantage, I don't think e-commerce is their best business. I think their cloud service, AWS, is by far a much better business than their e-commerce business. If you look at the shift from on-premise technology to cloud service, sort of renting memory and applications and bandwidth, it's much cheaper for businesses around the world to rent space through a cloud service offering at AWS than it is to hire the engineers, hire the technicians, staff them, buy the hardware and the software, try to make it all integrate properly. You know, it's very difficult for companies to do that, especially when there's a shortage of technology talent. So if you look at the amount of outsourcing that's gone into cloud services, we're probably in the mid to high teens at the moment. Keep in mind that this is a business dominated by Amazon, Microsoft, Azure, and Google is coming on, but this is a huge global market. It's technology is a $2 trillion market. And we think that penetration in the mid-teens today is going to grow. It's also a business that generates very high operating margins. You're talking about 30% op margins. And there are no, really to re-enter that market today, given the scale advantages of Amazon and Microsoft, it's almost unbelievable. So, you know, you really have to go one company at a time, one technology platform at a time. I do think Amazon and Microsoft do have growth rates that will exceed 10% for the next 5 to 10 years. And that's kind of what we're looking for. We're looking for businesses that can grow higher than sort of 8 to 10% organically over a 5 to 10 year period of time. These are businesses that have high and improving free cash flow margins. I would put on the other side of that maybe an Apple, which is very much hardware kind of shifting into services and software. But that hardware piece, that iPhone piece, you know, typically they'll see price declines. They haven't seen those price declines for a few years, but we expect that to continue. So, you know, if you look at the competitive advantage of a cloud service or an enterprise software business relative to a hardware business, there's no doubt we would prefer the technology platform companies.
Mm-hmm. Andrew?
Yeah, so, you know, look, I think these stocks are less vulnerable to kind of competitors in disruption because their valuations have come down. They really have lagged the market over the last, with maybe the exception of Google, the last, 10 months. And the result is, and I always like to say, look, Microsoft, as I said, traded 100 times earnings in 2000. It's down to 30 times earnings today. It's far less vulnerable to something that comes along than it once was. And this is the rotation into some of these cyclical stocks. Some of those companies have not participated, and that's good. That's a healthy thing. That means that if you get some type of competitor, it won't as negatively impact the stocks as what I would say this other group of kind of the faster growing, maybe they don't earn money, disruptive stocks that have really captured, the zeitgeist, these disruptive ETFs. Mm-hmm. Those are the companies, in my mind, are much more vulnerable to competitors that come along. So totally agree with Amazon. One thing I will say about Apple that I find incredible, and it's a good thing and it's a bad thing, is their services business is as big as Facebook. So they've created a second company out of nowhere 5 years ago that's as big as Facebook, or a company of that size. So on the one hand, that's really impressive. On the other hand, that's really hard to do. Can they do it again? And so it goes back to your question a while ago about concentration. Ultimately, the thing that gives me the most confidence or in the outcomes of these companies is eventually you just can't keep growing. It gets really hard to grow. And all you have to do is look at what were the biggest companies in the S&P or the Dow Jones or any index 40 years ago, and they're not around because you can't keep growing. And so to me, that ultimately is the biggest risk for these companies, more so than kind of disruptive competitors. Ultimately, you just can't keep growing, and it gets tougher and tougher.
Well, I mean, that is fascinating. We could stay here and talk forever, but unfortunately, I think we ran out of time. I hope the audience had the same, awe that I am by listening to these two global experts here. We here at XP are trying really, really hard to bring the best content, the best products to you guys. And I think we've just been, very fortunate to have two global experts to help us navigate what are, interesting, as I said, times. With that, I mean, I'd like to turn over to each one of them for their final remarks. Why don't we start with John this time?
Sure. Well, I just want to thank you, XP and the management team for allowing us to invest your shareholders' capital. It's a great honor. Listen, the future is difficult to predict. Outcomes are varied, and something new will come up in the next 3 months that we hadn't planned on and hadn't expected. And it's the reason we have created this investment philosophy and process that really focuses out, 3 to 5 years on companies that can grow organically at a rate that doesn't require mergers, acquisitions. These are highly profitable companies that generate a lot of free cash flow, that have very little debt on the balance sheets, and management teams that are capable of allocating that capital to create shareholder value over the long term. So valuation is ultimately what a group of investors are willing to pay for a stock, and at the point where you can buy these businesses that are creating enormous economic value at the right price, that's the key to success in generating positive outflow.
Thank you, John. Andrew?
Yeah, great. Well, so look, we're Morgan Stanley Investment Management. We're very excited to participate with XP on this global BDR fund. And I'm personally looking forward to more of these calls. And just to remind you, we are what I like to call us a core manager, because I believe that, as I said before, stock prices dislocate from fundamentals. And that is because sometimes stocks get too beloved, and sometimes they get too cheap. And I agree with many of what John said, which is a quality metric over time works, but within certain sectors, they can fall out of favor. So we keep an open mind in order to capture that emotional response that causes stocks to be mispriced. And I don't know, like in 5 years, whether that'll be US or non-US or Europe or Japan or value stocks or growth stocks, we'll take advantage of that. And finally, I'm a believer in a few number names. Don't own a lot of stocks, but have good risk controls and know how to put stocks together, portfolio construction, which you listed initially, so that not all stocks is zig and zag. We like financials and energy in the United States, but I like Chinese technology stocks because, as we've discussed, they've gone down a lot. So that's a great combination, because they don't necessarily all move together, but a limited number of positions. So thank you again.
Well, with that, I'd like to thank the audience very much. It's been a pleasure, and I'd like to thank very, very much John and Andrew for the participation. Thanks a lot, and good evening, everyone.